Focus. Ideate. Innovate. Enable.
Hello and welcome to the curtain raiser to our 8th edition of the CNBC TV18 UTI Mutual Fund Financial Advisor Awards. For the past 8 years, both of us, CNBC TV18 and UTI Mutual Fund, have been galvanizing the financial advisor community to propel itself to higher and higher standards of excellence. The last year, we had 38,000 nominations for this awards, and the jury has a hard time trying to pick regional awards as well as national award winners for their contribution to educating their community, the way they serve the investor community, and the way they improve their standards of service and of communication.
Recognizing the critical role that financial advisors play in the wealth preservation process and the power of sound advice, UTI Mutual Fund and CNBC TV18 celebrates the effort of financial advisors across the country. Over the years, the Financial Advisor Awards continue to honor the best financial advisors who have set benchmarks in the industry by maximizing investors' returns through sound advice in the highly volatile market. This year, we kickstart the 8th UTI Mutual Fund and CNBC TV18 Financial Advisor Awards with a power-packed interaction between Latha Venkatesh, the Executive Editor of CNBC TV18 and the MD of UTI Asset Management Company, Puri.
Can you begin by highlighting to me how you understand the role of the financial advisor? Clearly, 2016 has taught us that change is the only constant. In terms of finance, we are being buffeted by more and more unexpected news. So how does that change the role of the financial advisor according to you?
It continues to strengthen the necessity of such a profession, and indeed it is becoming a profession. Even more so in times of uncertainty. The need for the balance, the rationality, the ability to step back becomes important. The ability to contemplate longer-term issues and balance between consumption and savings, intergenerational savings, retirement. These are issues that become perhaps even more pressing at this point. So I think it's very timely that we are hosting this, the 8th edition.
Okay. Well, the 8th edition also comes on the heels of the demonetization, whose positive avatar is really digitization of the economy. I mean, per force, we are seeing people accepting non-cash payments, either plastic or digital movement of money. How does that change the role of the mutual fund industry itself? Do you see yourself getting more customers?
Yes, I think we have virtually doubled. The industry has virtually doubled in the last 3 years at 16 lakh crores, from 7 to 8 lakh crores. So let's not forget the very good news on which we are riding. We'll come to some of the concerns later, I'm sure. But right now, the good news is we more or less doubled. Clearly, that has represented an opportunity for professionals in the industry. Demonetization is fundamentally good for financial inclusion. As you say, digitization is a way to catalyze people's participation in the formal economy, and a large part of that will eventually find its way into our industry, into both debt and equity products, balanced products as well. So this should be seized upon as a chance to say the number of investors is going to expand dramatically, both because of our demographics, but now because of this catalyst. And therefore, the volume of money that our sector is going to have to absorb and deploy is also going to go up in a non-linear way over the next 2 or 3 years. It's a very welcome opportunity for us and should bring some cheer, New Year cheer to our advisors.
Okay. Before I come to the advisors, sir, this digitization and expansion of financial inclusion in the real sense of the term also brings with it challenges, doesn't it?
The great Indian middle class,
yes,
which numbers anywhere between 150 to 400 million people, depending
yes,
on who is measuring it. That is the belly of our financial system. They are not participating actively at this point in our industry. It's still somewhat dominated by institutions on the debt side, and HNIs on equity in terms of the lumpy flows. So it's not a matter of virtue, it's a matter of economic necessity for us, if we wish to grow, to actively engage with this segment. Fortunately for us, digitization is lowering the cost of acquisition and the cost of servicing. Fortunately for us, regulation is making it easier in terms of onboarding through Aadhaar-based KYC and overcoming some of the operating restrictions that we face. So with these tailwinds, we have less and less excuse not to go out and embrace this segment. It's a really, really good time to be in our industry right now.
How do you see digitization in the mutual fund sector itself? Are you all end-to-end e-KYC to e-payments to electronically reaching out payments? Can it be done really facelessly?
Our view is, if a person has come on board, let's say with a bank, and been declared compliant, we should simply be able to take that and move on instead of getting them to redo their KYC. The insurance industry, I'm told, does this. At this point, you need to still do a separate KYC for the mutual fund industry. And I think to any lay observer, that would immediately raise a question, why? If a bank has done so, why do we need to? And the bank by now, thanks to Jandhan, has done a KYC on almost everyone, we are told. So I think that I would use this as an appeal to say, let's just close that last mile. That will really help us push forward. And I think our own regulator, SEBI, is very supportive of this. It needs a little bit of help from the Ministry of Finance. So operationally, that is the bottleneck we need to overcome for onboarding and so on. Then it's up to us to make the investments in servicing. Our industry is still viewed as a little complicated. One of the reasons people like a bank account is it's now viewed as quite simple. We need to replicate that level of confidence and simplicity as opposed to being viewed as a bit of a black box. They need to believe that they can get their money out as easily as they can put it in. I think next year you will see many of us taking that issue up more seriously, which is repositioning ourselves as a much easier platform that will facilitate transactions on par with the standards people have come to accept from the other parts of the financial system, in particular banks.
Well, Mr. Puri, hold on to that thought. We need to take a break. We are back with more questions for Mr. Puri about financial advisors and where they are in the process of evolution. Welcome back to the special curtain raiser of the Financial Advisor Awards, which are now in its 8th year. I've been speaking with Mr. Leo Puri. Let me come to the advisors. Now, your hands and eyes and ears to this non-included India would be the financial advisor. Are you seeing the advisor poised to get the unincluded into the sector?
The positive view is that, as I said, there's been tremendous growth that has been accompanied by growth in earnings and in the stature of the profession. There are many people I meet right across the country who are proud of what they do. Some of them are second generation. As demonetization, financial inclusion happens, they have a chance to further expand their underlying franchise. Now, the concerns appear to be of two kinds. One is that there's a perception that the new regulations that are being proposed and are under discussion might somehow constrain their ability to grow and retain their franchise. And the other is a fear of technology and digitization.
One of the sitting ducks or very obvious candidates for mutual funds would be those who are getting ESOPs in IT companies. Do you see the advisors approaching that community, which should obviously be the next recruits? Likewise, do you see the advisor community going to this informal sector? People who deal in large amounts of cash in grain trade or cotton trade or vegetable trade. Are you seeing that growth, both in terms of age and in terms of geography?
We see anecdotal evidence of it. We don't yet see a movement, which is what is needed. I think for a country of this scale, the odd anecdotal sort of piece of history we get now and then is nice to hear, but it's not going to be enough. Absolutely, we need a tremendous movement. And I think that this concern that somehow the regulator is opposed to the idea of the expansion of this community is a misguided one, in my view. The country does need many, many more intermediaries to actually provide the kind of service, and technology per se does not substitute for this. The fear of technology is partly a generational issue. Just as it is with clients, there are some advisors who have grown up in a world where they were not familiar with this and who are still perhaps a little concerned. And they can see how the power of technology lowers their own cost of operating, lowers their cost of interaction, lowers their cost of sales and conversion in a way for them. And this is all good. These are all good things. And I would expect that the regulator is listening to some of the legitimate concerns that advisors have, and they have concerns around, for example, the level of eligibility. We have a love in this country for letters after our name,
Yes.
Degrees. We collect degrees. This is a profession that does not require you to collect degrees. So it's actually an anti-egalitarian idea to start imposing some form of so-called educational filters. That's not, it's character, integrity, ambition that you actually need to succeed. And that should be the joy of our profession, and that's one of the ways we open opportunities. And I think that's more in keeping with where the temperament of this government is when you talk about employment creation for the youth. There are also some issues that need clarification around how fees are going to be collected.
Exactly.
As an advisor. This concern that Indian investors don't like paying fees. They're happier if it is deducted as an embedded commission.
Yes.
They don't mind that. They know that that is happening. They don't mind it. But somehow they would be unhappy if the same amount of money was taken for them as, if you like, a deduction made by the person providing the service as opposed to the manufacturer of a product. Yeah, and of course, there is some truth to that, but it's not as deep-rooted as people might think at the end of the day. This fear that you have to go out chasing your clients to collect your fees is where some of the angst currently is.
That's right.
And I see some opportunity for us to close the gap of misunderstanding between regulator and this community by perhaps finding a sensible solution there. Longer term, I think what the regulator is trying to do is to simply say, and this is in line with every regulator in the world, that investor protection is the #1 priority. That's right. Investors should know that as an advisor, you act in their best interest. In order for them to be confident you're acting in their best interest, you should not be directly paid by a manufacturer. But it's in the implementation and the transition from where we are today to this concept that we now have got all these tangled wires. So I don't think we should resist the core idea. I think it will help our industry if investors trust our advisors more. It's in our interest, my interest as a manufacturer, to have advisors who are more trusted, not less trusted. And I need to step back, therefore, from the whole process of inducements and so on as a manufacturer, which is what is clouding and muddying the waters.
Evolution of the independent.
It's my job to produce the best possible products and make them available. I will make them available through advisors. For the self-directed customers, they will use technology and so on. So that's, I think, a much healthier, more sustainable way for us to grow our industry, and we will hopefully cross this turbulent dialogue within the next 2 or 3 months.
Well, that actually was the core of what I was going to ask you, but let's take a break. I also want to seek your advice for the advisor community on the tangled issues or difficult issues of digitization. We are back in a minute. Welcome back to our curtain raiser to the Financial Advisor Awards. These much-watched awards for the last 8 years have been attracting literally thousands of financial advisors who compete for the best place in the industry. I've been speaking with Mr. Leo Puri. Mr. Puri, digitization. What would your advice be to the financial advisor? He has to cater to one level of maybe a youthful audience, which will be very glad if they are approached only by WhatsApp and communicated through email. There will be a large bulk of senior customers who will be uncomfortable with electronic devices. So what is your advice to the financial advisor?
It's common sense that you need to work with both segments. It's true that I think about 30% of investors now are under 30. 42% apparently are under 40. But, you know, the third who are under 30 is obviously many who are millennials,
yes.
Famously short on attention span, attached to their devices. With that 30%, you have no choice. If you want to retain them, you must be able to deal with them in terms of the behavior patterns that they are witnessing when they deal with e-commerce and other financial sector participants. So what technology and digitization is allowing you to do is to do all this at lower cost. It requires an upfront investment. A lot of that investment is being also made by manufacturers, so the advisors don't have to make it on their own. There is this notion of the B2B to C,
yes.
The business to consumer platforms that are being created. And I think those are the right things for the advisor community to leverage and utilize for this segment as well. They are not all self-directed. In fact, they are worryingly not necessarily very financially literate. Just because they are digitally literate does not mean that they are financially literate. And for reasons that are, I think, more complex, if anything, they are possibly a little less ready to deal with their financial affairs, partly because of a drive towards consumption,
yes.
And partly because they are very sensitive to peer advice as opposed to so-called expert advice. And there's some shifts there, and that's not entirely without its dangers. We'll have to see. These are all evolutions. I wouldn't want to be so Luddite as to say we should not try that. But I do think somewhere in the middle of all this, there is still a need for that outdated notion of professional expertise. And we have to hold on to that, even as we go with the grain in terms of the methods of delivery that this generation is accepting. With the elder generation, they want a degree of hand-holding.
Yes.
No problem there with social community and so on and so forth. I mean, they look at that, but ultimately they want to know what the doctor said. And there, it's a higher touch model. There is room for more personal engagement. And I think that must continue. There are also different issues related to succession and intergenerational transition. We are not yet very well equipped to deal with issues related to inheritance and so on. But as we become more prosperous as a country, and if you look at the West, the bulk of financial advice actually happens around inheritance. Why? Because that's what happens when economies develop and the bulge, if you like, goes towards the elderly generation. So we're obviously not there yet, but for that segment, those issues are not very well addressed today. And I would certainly recommend to our advisors who are seeking new roles for themselves to really deepen their knowledge and understanding of how do you play a role at that point of transition in people's lives, because the amount of wealth that is now involved in legitimate inheritance is rising at a fantastic rate in this country. You have both real assets and financial assets which have risen in value beyond what people would have imagined when they started out on their working lives, and this must be handled carefully and well.
Fair point, Mr. Puri. You have laid out several roles for the financial advisor, and last year the awards attracted 38,000 numbers by way of candidates. To be sure, this time there will be more, and Mr. Puri has laid out the high standards that financial advisors have to live up to be able to cater to the youth, to be able to cater to the unincluded, the non-included so far, and speak to them in jargon-free language, to be able to cater to the aged customer and handhold them through technology, and at the same time be able to handle both the elementary needs of a saver becoming an investor and the mature, rich families passing on their inheritance and helping their next generation manage the wealth. All these are challenges for the financial advisor community, and they will be measured in this challenging fashion in the Financial Advisor Awards of 2017. Thanks for watching this special edition of The Curtain Raiser.
innovate, enable.